What's going on, millionaires? You're listening to the Million Dollar Mind Podcast, episode 181 on multifamily real estate, funding, and collaboration. Now, you guys know we have had a ton of different content episodes, conversations about real estate, funding, how to get into real estate, so many different ways to get into this massive industry and the importance of getting into the industry. So that's why I'm super excited to have this conversation. We have Veena Jetti in the building, and Veena is an entrepreneur, real estate investor, all of the above. She has over $1 billion in real estate assets over her career. She's a philanthropist serving and giving to several nonprofit organizations, and is the founding partner of Vive Funds, a commercial real estate firm that curates conservative opportunities for investors. So I'm super excited just to talk about that venture, Veena. And before we dive into today's content, if you could tell our listeners a little bit more about you, how you got started in real estate, and most importantly, what they can expect from today's conversation.
Yeah, thank you for having me. I'm excited to be here. I'm Veena Jetti. Like you said, I'm based out of Dallas, Texas, and I run a company called Vive Funds. We're a large multifamily owner operator with a focus on Class B value add assets. And typically our buy box is 200 units and up, 75 million or above on purchase price. So we have like a very narrow buy box that we work within. As far as how I got started, so I kind of started, I had a little bit of a head start, I would say, because my family is actually a real estate family. So I had an opportunity to see real estate as the foundation of my family's portfolio and wealth growing up. Now, we certainly didn't have money growing up. I'm the daughter of two immigrants. My parents built everything from the ground up. And I'm actually the first in my family to invest in multifamily assets. But my parents did residential and they did it at scale. Now they're both retired and fully invested into our multifamily assets. But I come from a real estate family. I graduated from college when I was 20 with my degree in finance from the University of Illinois. And then I ended up going to work in corporate real estate. And I worked for somebody else for a while and realized that, wait a second, this isn't the best use of my time or my skill set, and left corporate America, ultimately started investing for myself and my family, and then just continued to scale up from there. Now I've transacted on over $800 million in multifamily assets since leaving corporate America.
Awesome. I love to hear it. And I'm really excited to just dive into your personal transition from, coming from a family in real estate, them having most of their experience in single family, to transitioning to multifamily. As you know, it, can be very similar, but very different at the same time. So, before we get into that, Veena, welcome. I'm super excited to have you on the show. To our millionaires that are tuning in for the first time, excited to have you on on the show and joining us. And to our vets that tune in every single week, Monday and Friday, welcome back to the Million Dollar Mind Podcast. This is the #1 podcast in the world for passion attraction, and you are in the right place if you are here looking for money-making tips and tricks to just live a more passionate life. And Veena, let's dive right in, right? So you said your family started off in the single family real estate, and you are more so focused in multifamily. From your experience, what kind of guided you down that path to multifamily instead of more so, following the path of single family and want to kind of transition into that route?
I actually did start by acquiring single family homes in our own portfolio because it was what I knew. It was comfortable. It was something I was familiar with. And so I did start there, but what I very quickly realized was that's not the way to scale. You cannot get to the same portfolio size doing it one home at a time, save for the Blackstones of the world that buy 40,000 homes at a time. But for us, it was just not possible. My busiest week, I think I was buying like 5 a week. And it wasn't enough scale for me to justify the cost of, having somebody work for me full time or managing the assets full time. And I really disliked the property management side of the business. So I needed to get to scale quickly. And that's where multifamily really stood out. And then also multifamily allows you to finance it easier. It's less risky than single family assets. It's not quite as volatile. So I liked all those things because I'm a conservative investor by nature.
That makes a lot of sense. And so with a couple keywords you said, it's less risky, easier to get funding for, definitely less volatile. For our
Yeah.
listeners that are tuning in and really just kind of catching wind to multifamily for the first time,
Mhm.
what about multifamily real estate makes it less risky, less volatile in the market, and maybe even in some cases less competitive when it comes to purchasing and finding these properties in a market like today?
I don't think it's less competitive. I
Okay.
think you're just competing against more sophisticated buyers the larger you go. Maybe you're not competing against someone who's going to grossly overpay for an asset like they might in single family, but you're competing with very sophisticated and very sticky and aggressive dollars at the level we transact at. So I don't think it's less competitive. It's just different competition. As
Hmm.
far as risk goes, one, your vacancy risk is much lower. So if you have a single family home, your tenant moves out, you have 100% vacancy. If you have 100 units and one person moves out, no big deal. If you're 100% occupied, you go down to 99%. If you're 95% occupied, you go down to 94%. Not a big deal. You're not really going to feel the pain at the bottom line. So that's one reason I think it's less risky. It's a more stabilized asset class as well. It's less volatile because the valuation is done based on the business of the asset. On true multifamily, it's valued based on the net operating income, and the cap rate and market value is derived from both of those two numbers. Whereas on a single family home, if your neighbor down the street sells their house for a 30% discount, they've totally screwed your comps for your single family home. Multifamily does not operate that way. It's based on the business of the asset, which means also it's easier to get funding for. So it's much easier to finance multifamily assets because, I mean, they are looking at Veena, Jetti as a borrower, but not just Veena, Jetti as a borrower. They're looking at 123 Main Street apartments. What can these apartments do? Are we going to be able to pay it back? Is it going to be operational? Is there risk there? So getting funding for multifamily assets is actually a lot of times much easier.
Okay. Now I know that when it comes to running the numbers, it definitely can be much easier. From my experience, the more experience you have, right, in
Mhm.
multifamily and
Yeah.
purchasing these types of properties, for someone that has never invested in the real estate before, or might only have, one or two single family properties, what are some things that they should now put their focus on as they want to transition into multifamily real estate?
Yeah, I think you hit it right on the head, is understanding the numbers and getting comfortable with how these deals operate, how property management works. And like you said, experience does matter. And so I always like to encourage people to find partners that are complementary to their skill set, that can help them transact on larger deals and take it down together, or find a seasoned partner who, and I hate to say it this way, but sometimes you just have to pay them just to give you their name and their resume and their balance sheet so that you can go and do all of the sweat equity. And, I always tell new investors, even if you make $0, it's okay, because that first deal is so important to being able to open the door to all the other deals. So it's a long-term vision, a long-term goal. Don't focus on just that one deal.
I like that you mentioned like the word partnering up and
Mm.
collaboration, and as that's one of the topics for today, collaborative efforts.
Yeah.
And you even mentioned how you dislike, the property management side of things.
Yes.
So, what are some creative ways, as a new investor, whether you have all the funds and don't want to do the work, or have no funds and willing to do all of the work, what are some creative ways to kind of negotiate terms, or partner up with people to make this dream come true? Because I know a lot of people, I know specifically for me, to get
Mhm.
into real estate I had to go the wholesaling route.
Yeah.
And I know that's a route that a lot of people, that I know have to take just to kind of get their foot in the doors. But if there's another way, whether it's wholesaling, efforts as opposed to contracts, what are some creative ways that you kind of see in your industry that people can merge together and join forces?
Yeah, so for multifamily investors, a lot of our investors start off as LPs or limited partners in our deals. So they might not go out and find a deal, but they might say, hey, Vina, I love this project you're working on. Like I said, we transact 75 million and up is kind of our buy box. And so they might say, hey, I really like this. I can't give you a check for $30 million or whatever that number is, which most people can't. But they might say, hey, let me put 100K or 50K into this deal. Let me see how it works from the limited partner perspective. And that's usually like the first step. Is most investors that end up going off on their own start investing with somebody, whether it's myself or another sponsor. The second thing, or like that next kind of growth step that we usually see, is what we call a fund manager. So a lot of times they will run a fund of fund model under our parent fund. And, it's all SEC compliant. And, we send you to our securities attorney. We get them to file all like Form D, Form ID. We do everything by the book. And so we encourage fund managers who want to maybe bring capital or manage an asset or not operate a fund to come and bring their fund and invest it into our fund. And then they're not doing the heavy lifting of asset operations, managing the property managers, or the initial or the due diligence or initial acquisition underwriting that portion of it, because we're set up to do that. So a lot of times that's how they'll integrate with us. And then usually after they've done that a few times, we usually end up seeing investors that go out and get their own deal under contract. And, sometimes they'll bring it to us and ask us to partner on it. Sometimes they don't need us. So it just really depends. We will, a lot of times if we have that deep of a relationship, we'll look at, giving risk capital to new investors, or KPing or guaranteeing the loan for them. So there's a lot of different ways that you can utilize partnerships. It just depends what you really need and what your interests are.
Okay. Okay, that makes a lot of sense. And as far as, getting the funding as an individual, do you think that it's more important, not having the experience, of course, is it more important to try to get that funding as an individual or as maybe an LLC or a business?
As a business, you could get it as an individual, but most banks at truly like on multifamily, which means 5 units or above, especially as you get into larger and larger multifamily assets, most of them are going to ask that you have some kind of an entity set up. And your lender will usually dictate the structure.
Hmm. Okay. All right. Now I do want to hear about your journey into starting Vive funds. What was the motivation to starting Vive funds, and what were some of like the challenges you faced earlier on when with starting
Oh gosh, we don't have enough time to go through all of the challenges I faced.
it?
Yeah, so I really wanted to, I'm a mother to twin toddler daughters, and I really wanted my girls to know that they can be in the private equity space, and they too can, they don't have to choose between a career or a family. They can have both. So that's really important to me. And that's why I do what I do primarily. It's not, I mean, the money is nice, but it's not so much the money as it is the legacy that I'm leaving behind for them. As far as challenges go, man, there are so many. I think one of the biggest things, if I could go back and tell me starting a company, any company, if I could go back and give myself like solid advice on what I would do differently, it's easily that I would invest time and effort and energy into setting up systems and processes early on. And it's hard because sometimes you just don't know that you need a system for something or a process for something. And then it becomes this whole struggle of, okay, well, I don't want to put in the time to establish the process, but if we put in the time to establish the process, it would make everything else so much faster and more efficient. But then it's like, okay, but I don't want to dedicate that time because I just want to get everything done. And it's just this never ending cycle. So I think when we have taken the time to invest in processes, systems, automation, it's actually served us really well in the long run. It allows us to scale from one deal to the next, or be more efficient, or more importantly, give our investors, our passive investors, a better user experience. We are investor obsessed. And so everything we do, every decision we make is, how does it affect the LPs or their experience or their returns? And then we make decisions based on that at every single turn from top to bottom in the company.
Hmm. Now, are you finding the deals and the equity for these investors, or is it primarily just the deals or primarily just the equity?
Both. We do everything. We're A to Z operational. We do have a JV partner that we work with, so we kind of try to divide and conquer. So we are between both the teams, we handle everything from sourcing the deal, underwriting it, negotiating it, stacking the capital, signing the debt, doing due diligence, raising the equity, filing, all of the securities requirements, et cetera, distributing, operating, executing, and then exiting. So everything from the moment a deal comes across our desk till the moment we exit, we handle in-house.
Now that sounds like A to Z operations. All I hear is a lot of moving parts, a lot of
Yes.
people.
Yes.
When you first got started out, did you have all the people in place? How did you identify what people you needed in place?
No, we did not have all the people in place. We still don't have all the people in place that we actually need. Finding the right fit for the companies that we have it's challenging because we believe very strongly in a company culture. We don't like turnover. We want to make sure everybody that's here feels valued and appreciated and has the ability to bring ideas to the table. We believe diversity is our strength. We do focus a lot on hiring diverse teams across the asset and our companies. It's challenging sometimes to find the right fit for what we're looking for. And, it's always that struggle. And any entrepreneur will tell you this is by the time you have the cash ready and you need to hire an employee, it's like so far late that you're scrambling to find someone. But before that, it's the question of, is it responsible for me to bring on an employee because they're relying on me to pay their bills and their rent? And that's not something that I take lightly. That's a responsibility. And, and it's the flip side. It's being an entrepreneur. Yes, we can do really well, but when things aren't going well, I'm also the first to take a pay cut because I want to make sure that our employees are taken care of first. So no, we do not have our teams in place. Because we're growing so fast, we can't keep up with the amount of growth we're experiencing. We're constantly bringing new team members onto the team. When I started, it was just me. There was no one else. And that was challenging, but I did what I had mentioned earlier, where I took on just one slice of the deal. I wasn't A to Z operational. By the time we moved to A to Z operational, we had started adding team members and partners on board.
Okay, that makes a lot of sense. And one word that I want to hone in on that you mentioned, Veena, is the word diversity.
Mhm.
And just naturally, especially in the environment that we're in, I think when people hear the word diversity, they're thinking that diversity in how people look and the cultures in which they come from. But I even think that you meant a little bit deeper, and correct me if I'm wrong, a diversity in mindset and ideology as well, like making sure that people have different experiences so that they can bring different ideas and concepts to the table as well. Is that kind of what you meant by diversity?
Well, yeah, I mean, essentially having diversity from, race, religion, ethnicity, background, experience standpoint, that automatically translates to that diversity in mindset and thought process. And that's actually what we're after. I'm not trying to hire someone just because they're a woman or they're a minority or they're from an underrepresented community. I think that's great. And I think when we have the opportunity to create equity at the top, that's always preferable. But what happens, and we found this in our company, is that when we have people that are from different backgrounds than, myself or the partners of the company, what happens is we start to see those different experiences and those different thoughts and ideas come to the surface, which is why we also have an open door policy. Anybody in our company, all the way from the lowest paid employee to the top paid employees, everybody can bring ideas to the table and we won't reject them just because of where it came from. We actually will look at it. And if it's something that we can implement, we absolutely will. We are open to where a great idea might come from. And it might be just a blind spot for us, right? Like, I don't know what men in this business are thinking. I don't know what their experience is. I can't possibly know personally. So it's a blind spot for me, right? And so I think, or non-moms, right? Like, because now I'm a mom and that's how I see my lenses through that. So I think having different backgrounds, experiences helps us to be able to contribute better ideas or different ideas or new ideas.
And maybe even avoid certain problems too. That
Absolutely.
with having like a blind spot driving a car, you can avoid, hitting
Mhm.
another car by switching lanes and switching gears and maybe
Yeah,
pivoting a couple times. That's interesting. And I want to switch gears just a little bit, Vina, because right now we are in in a very volatile time in real estate,
mhm.
and a time that is paralyzing a lot of people from making any decisions,
Yeah.
especially in the residential side of things, where most of my experience comes. From your experience, how do you see that? Is it at all affecting multifamily and commercial real estate as well,
Yeah.
and in what ways?
Many ways. I think, interest rate risk is a big issue. We cannot leverage deals as high as we used to. So no deals are underwriting. Our cash on cash is getting murdered out of the gate. There's no cash on cash on 99% of the deals we're underwriting. We're looking for a needle in a haystack.
Mm,
As far as competition goes, it's still fairly competitive. I don't think that we've really seen less competition on pricing as much. We've maybe seen more softening of terms, if you will, of the deal. Maybe instead of having like 35 offers, we're competing against 7 or 12. So, a little less competition in that way. And cap rates are, somewhat correlated, like 60, 70% correlated to interest rates. So as interest rates have gone up, we have seen cap rates expand very, very minimally, though, because our markets that we transact in and the assets we transact on are highly stabilized, like institutional quality assets. So we don't expect to see a whole lot of movement on cap rates. We don't expect them to go from 3.5 to 4.5% overnight. Over the course of like 5, 7 years, maybe. Historically, they typically don't move that much in our markets on our assets. Anything's possible, but that's where I think being savvy and knowledgeable helps you, because you can make those assumptions and you can protect for that as you go into the project.
okay, so the markets that you guys primarily focus on, are they like the Atlantas, the Houstons,
Mhm.
the these major metropolis type cities, or are they
Yeah.
kind of up and coming cities?
No, we are, like you said, we're in Atlanta. We've bought and sold about 350 million there in the last 18 months or so, 20 months or so. Uh, Actively looking at several acquisitions there at the moment. North Carolina is another market we play in. We actually don't do the Houston market as of right now. It's not really in our risk profile, but we do Dallas, Austin,
Mhm,
San Antonio, Jacksonville, Tampa, Orlando, the North Carolina, South Carolina, Research Triangle of North Carolina. Phoenix is another market we look at, and there's a few other markets that we're actually looking at bringing online. So we typically will study a market and underwrite it for 12 to 24 months before we actually bring it online. So we have a couple that we've been looking at them and we've been evaluating them, and we may bring them online for either the end of this year or early next year.
okay, that makes sense. So I take it, with people migrating heavily from the north to the south, and the major development of these multi-use facilities like the restaurant slash residential areas, for you, you would say that this is still a very good time to invest in multifamily real estate.
I think every time is a good time to invest in multifamily. I get this question a lot. Are you
Hmm.
still investing, or do you invest in a down market? I mean, yeah, because if I don't, I'm not investing 50% of the time I'm in business. That's way too much for me to not be investing in. It's anybody's guess when we're at the top or bottom of a market. Instead, what has to happen, what I think seasoned investors do, is they invest, but their strategy changes, their underwriting metrics change, their assumptions change. And I think that is reasonable. But to not invest because of where we think we are in the market I mean, if you thought 3 years ago we were at the top of the market, you would have missed out on a ton of money in the last 3 years.
Hmm. Hmm. Yeah, I get that question asked a lot too, and I wanted to hear your take on it, because at the end of the day, I feel like waiting, you end up losing out either on the increase of interest rates, or you lose out
Right.
on the equity from rising prices. So either
Exactly.
way, you just want to kind of get in where you fit in, and just minimize your risk where you can.
Exactly. Mitigate the risk that you perceive at that point and for the near future. but you can't just stop investing because you think you might be at the top or bottom or middle of a cycle.
Mhm. So what methods have worked for you? Because it sounds like with mitigating risk, all of this, you have to just be savvy with the numbers.
Mhm.
Where you kind of started out, what were some methods that helped you just understand and not overcomplicate underwriting and just being able to find deals and things like that?
I don't know that we don't overcomplicate underwriting. We are pretty thorough, pretty in depth when we do underwrite our deals. And I will say we are more conservative than most sponsors. So take everything I say with like a massive teaspoonful of salt because I we just we got to a point where now every single time we send our underwriting to our lender, who's by nature the most conservative in the deal, they're rejecting it back to us saying, no, this is way too conservative. Go make it more aggressive and come back to us. Like our lender is telling us to be more aggressive. And like, I know that's crazy, but that's just how the nature of how we think. And, a big piece of that is because my co-sponsor, her family and my family, we invest into our deals alongside of our investors. We're oftentimes our own largest investors in our deals. And that means that we have a lot at stake, not just reputational risk, but we have dollars in the game too. And
Mhm.
so what we do is, sometimes we get into this whole bout of, okay, but let's just see if we take the NOI only up by 3% in year one. Okay, only 5%, only 10%. But we'll also stress test it backward too. So we'll say, okay, what if NOI doesn't change? What if we cannot be better operators? What if it stays the exact same? How does this affect investors? What levers do we have to pull if our investors are starting to get affected? Can we put more capital in ourselves? Can we reduce our fees? Can we waive our fees? So all of those things are conversations we're constantly having if things are not going according to plan. Now, when you underwrite that conservatively, the nice thing that happens is usually you're making a phone call saying, hey, by the way, we totally knocked it out of the park. I know we said we were going to give you 15%, but here's 47% or whatever that looks like. Right. And so, last month we exited a deal. We held it for 18 months and our investors made 1.8x their money back in 18 and a half months.
Mm.
And of course, I didn't tell them I was going to pretty much double their money in the course of 18 months, but we told them we're going to get you anywhere from 14 to 16% a year is what you're looking at. And then we totally crushed it for them. And that's how we continue to grow our capital side because our investors know that we are working hard for them, that we've made reasonable or conservative assumptions. And that if something is going wrong, it's not because we just didn't pay attention. It's because something is really going wrong that's out of our control.
Mm. Now, did you in that case, because that's an amazing success story.
Mm.
In that case, did you mean to under promise and over deliver, or it just kind of
Always
happened that
do.
way?
No, I always mean to under promise and over deliver. Now, when I say that, usually I think I'm like, all right, we said 14 to 16%. Maybe we'll get them to like 16, 17, 18% would be great. But I mean, I didn't know we were gonna, I didn't know we were gonna give them a 50% annualized return.
Right, right. Yeah, no, that's amazing. Congrats on that deal.
Thank you.
Where do you think most of the negotiations in multifamily happen? Is it still with like the seller as the buyer, or are you negotiating with the lenders, project managers? Where are most of your negotiations happening?
Everybody, everywhere. Because that's how you maximize investor dollars is
Mhm.
I'm negotiating with the seller to make sure that we're getting the best purchase price, best terms on it's not just the purchase price that matters. There's a lot of other costs that go into closing, but also just the structure of the deal. We want to make sure we're planning against risk for our investors. Like, for example, let's say there is I don't know, an earthquake and one of the buildings is no longer inhabitable and gets condemned. What happens then? Do we still have to close? Do we not close? What are our damages? How much can we reduce the purchase price by? Are they going to assign us insurance benefits? So there's a lot that goes into just something as simple as negotiating the contract. With the lender, we use the same lender over and over. So we use Melissa Quinn. I don't know if you know her, but she's based in Orlando. She's from Jones Lang and LaSalle, JLL. She's phenomenal. I trust her to close any and every deal. She gives us the best pricing possible. We've been working with her for years. Um, I don't know that we so much negotiate with her as she goes and negotiates on our behalf.
Mhm.
And then as far as vendors go, we're always looking at pricing. We're always looking at the scale we have. We're always looking at the business as a whole to see where we can either increase our dollars to the property or decrease our expenses. What I think new sponsors should remember is it's one thing to push rents or push income. There's only so far you can do that, right? And then people just can't afford it anymore, which okay, but for every dollar you increase your income, that's only going to be like maybe 60, 70 cents to your bottom line because you have expenses against that dollar.
Mm.
But if you cut costs and save a dollar on the expense side, that's a full dollar that goes to your bottom line. So new operators a lot of times will forget that, sometimes it's more efficient to cut costs than it is to increase your income. So it's kind of finding that balance and that blend of both.
Right. That actually makes a lot of sense because of course, if you want the max rents, then you have to put in the best finishings. You have to,
Yeah.
make it aesthetically pleasing for someone want to pay that max rent, which increases your expenses, like
Yeah.
you said. Where on the flip side, you can just focus on where can you cut the cost to
Right.
just keep as much money. That makes a lot of sense. I'm glad that you shared that, Veena, because we get a lot of multifamily investors. We get a lot of single family duplex investors
Mhm.
that I feel like the message may be, you know, do the finishings to get the best rent. And you kind of giving us a different perspective, which is always good to have multiple perspectives. What
Yeah.
baby steps can our audience just, listening to this conversation so far, what baby steps can they take to, get started, at least, familiarize themselves with multifamily real estate?
I mean, I think first and foremost, it's listening to podcasts like this, right? I'm sure you can binge all 180 something episodes, and there will be several multifamily investors that you've spoken with. I speak on a lot of these podcasts. There's a lot of them. I also like reading articles, just so you know what's happening in the time. But the one thing I tell anybody listening, right? If a free and actionable step that you can take is go to different sponsors, find like 10 or 20 or 100 sponsors that you think you may like to work with them or invest with them, and sign up on their portal, sign up on their list because it's free to do that. And all of us will send you our documents and we will send you our offerings. And what's important about that is not that, oh, okay, now I've seen Veena's offerings, I want to invest with her. That's not why you do it. You do it because, okay, I like what Veena's doing. I see how she's looking at this. I see how she's thinking about this. I see where the market is trending based on the emails I'm getting from these 5 sponsors. And then it gives you one, something to emulate. So you don't need to reinvent the wheel here.
Mhm.
And two, and more importantly, these are the people that you want to partner with. These are the people that you might want to buy from or sell to. So I would say, this is a relationship business. Foster those relationships. Start off by signing up in those portals, getting to know what different sponsors are doing, what their strategy is. And, I always tell even new investors when they call me, they're like, oh, I'm so excited. I want to put $300,000 into your deal. I'm like, okay, well, hang on. What are your goals? Are we aligned? I might not be the right sponsor for you. There's many times where I tell investors no, because I don't think that they're a good fit for our fund. I think they have expectations that are not in line with the true risk profile. I'll never give them financial advice. I'm not licensed to do that, but I do want it to be a thoughtful decision. I want them to review it. I want them to take time with their attorneys, their financial advisors, their CPAs, whoever they need, to make a good decision for their portfolio and their personal finance goals.
That's great advice. I love that advice. And to even add on that, you mentioned emulate. You get some type of template. When you're finally at that level, you have something to kind of go off of. But also, you're getting like research. You're getting notes, things that you can
Exactly.
copy and paste and import and download into your own mind. Veena, would you say that that is the advice that you would also give to your high income earners that are looking and ready to invest?
Oh, yeah, absolutely. I mean, there's no reason you can't have multiple sponsors lists that you're on. And I'll tell you too, this is something even at today, as much as I've transacted on multifamily, I sign up on other multifamily sponsors because I invest into other deals. So I'm always looking at other deals so that we can invest into those deals for our personal portfolio. But I sign up on lists of people that are not even in this field, or they maybe are in a different field of real estate where I just see what they're doing and I want to know, how do you do it? And I want to take the best parts of their business and their practices and emulate it in mine because I want to be better at what I do. And it doesn't mean that it has to come from another multifamily sponsor. For example, I don't know if you know Pace Morby, he runs the sub two community and he's got a massive following, and his base is just so loyal and so wide, and he has built a phenomenal successful business, and he makes everybody feel like truly part of that community, and he builds that really like strong emotional connection. And I don't know how he's scaled to the size he's scaled over the last few years, but I'm on all of his lists. If he tells us like, hey, I'm running this challenge, I'm signing up for it, not because I'm trying to learn how to do sub two deals. Like I'm not going to buy single family homes. It's just not in my bandwidth or the cards for me, but it's more because I want to know all of the intangibles of that. I want to know, how are you talking to your community? How are you interacting with them? How are you building your brand? What are you using to build your social media presence? So like all of those things are things that I'm looking at, even if I'm not looking at the content of the real estate side. So I think any potential investor should be looking to do that.
Mm. I like how similar that advice was to advice we've gotten last week, Veena, and it was regarding something totally different.
Oh, really?
One of our guests was saying that he'll sign up for like a conference, or he'll sign up for a networking event and don't even know what the content is, right? He just signs up just to be in the room. Right.
Yes,
Even if it may cost 5,000, may cost
doesn't
10,000,
matter.
he'll sign up just to be in the room. And you're pretty much saying like, it doesn't matter the content, you're doing it, one, for the reps, two, for the intangible information, the how-tos, the outside of the box information, because the information all changes, but sometimes the strategies stay the same.
Yeah, I mean, it's the same thing I say about like these masterminds and these groups and stuff like that. You're not paying to understand what an IRR is or a cash on cash means, right? Like you can Google that. You can
Mhm.
find that. You don't need a mastermind to tell you that. The power of a community is you're getting everybody else's mindset, you're getting everybody else's experience, and more importantly, you're getting proximity to the person that you want to be transacting with, or you want to transact in the way they're transacting. And that's the power of those communities. And it took me a really long time to realize that because I was resistant to joining any of these until recently. And then I was like, oh, I get it. I'm not trying to learn what Pace is teaching in his course. I'm trying to learn how Pace thinks. And I'm trying to be the person that when I pick up the phone and call him, he answers my call. Like that's what I'm trying to get out of it.
Great takeaways. Great takeaways. What do you think that, knowing what you know now,
Mhm.
what would you have done, or how would you have moved differently in the multifamily real estate space, but also in starting Vive funds?
Mhm. So in starting Vive, it's the same thing I said earlier. I would have spent a lot more time, money, energy, effort into putting processes and systems in place. It would
Hmm.
have saved me so much heartache and so much time later on down the road. I also would have looked at partnerships, not just in my core business, but in ancillary businesses. I would have looked for partnerships where there can be an operational partner, and I would have let them run with it. I wish I had started doing that sooner. I do that now, but I wish I had done that years ago. So that's on the Vive side. From the multifamily side, oh man, the thing I say to everybody is something that I did do, and I think it served me really well, is understanding the numbers. Everything's going to stop and start there. If you understand your numbers, you can raise your capital, you can target appropriate deals, you can operate deals. So understanding the numbers is kind of the basis. Like I said, my degree was in finance, so I kind of had like that baseline financial understanding, but there are so many websites and so many videos and so many podcasts that go into depth about underwriting.
Great answer. That's That's an amazing answer. And as we are transitioning, Vina, I one want to say thank you for just the insight that you're giving us into our millionaires and just how to think outside the box when it comes to this multifamily. We talk a lot about single family, so this is a different
Yeah.
type of conversation,
Yeah.
not just for me, but for our millionaires that are tuning in as well.
There's just a few
But
more zeros on it.
just a few more zeros, a few more units and doors, no
A
biggie.
couple, not that many. It's all the same.
So with this one being a passion podcast, we're solely, because it's great having the vehicle, great having the engine that is going to fuel the life that you want, but it's most important that we find different things that we're passionate about first and that we can develop a love for. So where in what you do now did you find your passion, and what kind of drives and excites you the most?
So, my mom will tell you, I am somebody that when I put my mind to something, like I just do it. So she'll always be like, "Oh, well, when Veena has a bee in her bonnet, she'll make sure it gets done." Um, and I didn't set out to build this company. I didn't know I was going to build this company. I started doing it. It was fun. I liked it. But then as I really narrowed and focused in on what I loved to do and started investing time and dollars into building the company that I wanted, it became something that I can't, I don't want to stop. I'm young. If I stop now, I don't know what I'm going to do all day long. I mean, my kids are going to go to school soon. They're eventually going to get to an age where I'm not that cool anymore. Right now I'm cool. So they still want to hang out with me, which is nice. Uh, but they're going to get to an age where they're not going to want to hang out with me. They're going to hang out with their friends. And I don't blame them. I want them to go out into the world. And so when that happens, I want to make sure that I have something that is equally exciting for me to do. And, I love what I do and I want to keep doing this. And so that's why I keep doing it. And I think too, the other thing is there's not a lot of women or minorities represented in the private equity space that transact on the size of deals that we transact on. And for me, it's really important that, my girls and other girls little girls have someone that they can look up to and see, and that representation is important to me. And if I don't do it, then my kids won't know that they can do this.
Mm, that's amazing. That's amazing, and I'm so glad to just have someone like you on the show that can speak to the people that may identify with you, that up until now didn't think there was anybody in that space
Yeah.
and probably didn't even know anything about the space or could see that for themselves. But up until
Totally.
this conversation, now we're thinking, well, I want to get into that now too.
Yeah.
So big ups to you, Veena, and much appreciation that to have you on the show. And before we wrap things up, we do have a segment that I like to call rapid fire, that I
Uh-oh.
like to have with all of our guests. And
Okay.
it's just 5 random questions that have nothing to do with real estate, multifamily,
Okay.
or anything we talked about.
Let's
So
do
it's just
it.
to have fun, lighten up the mood, and to get you to open up, but most importantly, to have fun, be brief, be brilliant,
All right.
and answer with the first thing that comes to mind.
Okay, let's do it. I'm ready.
All
Should I like
right, the
stretch
first
first?
one.
Do I need to like
Yeah,
loosen
go ahead and
up the
stretch it out.
muscles?
Stretch out
Okay.
the kinks.
Okay,
This
I'm
first one
ready.
might be easy to answer though. This one is if you had to teach a class on one thing, what
Oh,
would you teach?
okay. I mean, I think that that's obvious from actually, I'll make it more specific than just like real estate or multifamily.
Hmm.
I really love the investor relations side of the business. So I would actually teach like on how we handle investor relations and raising capital on the equity side.
I like that. That's very specific and niche down.
Yes. Yes. That's
Awesome.
my favorite part of the business.
Relationships, because that's
Yeah.
really what it all boils down to
Yeah.
anyway.
Exactly.
Awesome. Number 2, what's one bad habit that you're trying to get rid of?
Oh gosh, I have so many bad habits. Gosh, which one do I confess to online? No. I was in the habit of going to my Pilates class every day, 5 days a week. And then I started traveling and I got sick. Like we had like the flu and it was just all crazy. And so I got out of that habit. So I guess it's a good habit that I'm trying to reestablish. And Oh, my confession is I do love junk food, like fast food, Taco Bell. Like if you put it in front of me, I'm gonna eat it. And so I have like a really bad sweet tooth and I like fast food. So I'm gonna break that habit. Like my birthday is in a couple weeks. That is my plan for my next year.
To get rid of junk food.
Get rid of junk food and go back to my working out routine.
So no cheat days after your birthday. No cheat days.
I mean, I don't like to call it, I don't want to be like that strict about it, but maybe just like, maybe I go to 50% of how often I'm willing to eat junk food.
Gotcha. Okay, I love it. Well, happy early birthday,
Oh,
being
thank you.
I hope that you enjoy it. Number 3 is, when you think about success, who comes to mind and why?
Like what person do I think is
And
successful?
and you know what? I want to modify that, because I really want to see what comes to mind and why when you
Okay.
think about success.
It's funny because when you first asked me, like, when you think about success, what comes to mind? And immediately, like, my family, like my kids, my husband, my extended family, like, came to my mind because I was like, to me, that's success, is having that family, that support system. Like, the whole reason I do what I do and I give up what I give up is for them. And so for me, just having my kids and my family happy and healthy is that's the epitome of success for me. As far as what comes to mind, it's time. It's being able to control your own time, not going to work because you need a dollar, not being a slave to your 9 to 5. It's being able to control your time and live life just completely on your terms and however you want to live it.
I love that answer. And I even want to, add on to that, Veena, because you said time and being able to spend time with the loved ones and doing what you enjoy most. And I think it's interesting that most times, us, when we think about adulting and responsibility, we think and have this understanding that to be a responsible adult, you have to, sacrifice and work the job that you hate, just to pay bills. And it really sounds like a responsible adult will, make it happen to do what they love while still being able to provide the life that they want to live.
Absolutely.
And that's having that time
Yeah.
freedom that we all wish to have and want to have.
That's all it's about. And, and I will say too, if I had to work a job I hated to put food on the table and like provide for my kids, I would. There's no question in my mind. That's very respectable. It's just, I want something more out of life. And no one will ever outwork me.
Hmm. Hmm. It's like it's a pit stop, right?
Yeah,
It's not the last
exactly.
stop.
Stepping stone. That's all.
Exactly. Number 4, what book belongs on everyone's bookshelf?
Oh, this is good. Okay, and I'm somebody who I don't read like a whole lot of real estate books, and everyone expects me to be like, oh, this real estate book. But I'll tell you, I love the Malcolm Gladwell books. I've been reading Outliers. I've read it like 4 times in the last 3 years. I've read it over and over and over again because I think it's just a phenomenal book to show you the power of like numbers and I'm a nerd about numbers, so I really enjoy these types of like stories and stuff. So that's a book I think is really good. I think everybody should have The Millionaire Next Door. I know there's an updated one. I have not read it yet, but it is actually the first financial book I read that gave me, like, my parents made me read when I was like 14 and it was so boring, but it served me well in life because it really gave me a financial foundation and an understanding about money at a really young age. And then real estate wise, I think What It Takes by the founder of Blackstone, I'm looking at it because it's right here on my bookshelf. Stephen Schwartzman is a really great read because it talks about like how he started the company and kind of everything that he went through. And so I think that's also another really great read.
I've heard of Outliers. I did not hear of The Millionaire Next Door.
Oh yeah, you
So
should
you
read
just
it.
gave me one that I'm going to check out and add to my Audible account.
And it's like such a quick read, but there's a new one now called, it's either called The New Millionaire Next Door or The Next Millionaire Next Door. And
Mm,
it's actually a collaboration. I think his daughter wrote it.
I
So
think I want to
definitely,
read both.
yeah, definitely check it out. I haven't read the new one yet, but it's on my list.
Awesome. Well, thanks for sharing that, Veena. And we have number 5, the last question on our rapid fire round. What's your favorite thing that you bought yourself this year?
Oh, these are supposed to be easy questions, but I'm trying to think because I don't really buy a lot of like material things necessarily. I really focus on experiences.
Mm,
So like, can I have bought myself a vacation?
that
Okay.
counts.
Okay. We went on like this big family vacation in May. Like my kids, my husband, my in-laws, my parents, my brother-in-law, our au pair, and it was so much fun. And I like cruising because it's like usually there's like a period of time where I don't get great reception, so I can't really be working. So I get to actually disconnect. But we went on like a week-long cruise. We hadn't gone anywhere on vacation since COVID, and I was very happy about it. And it was exciting. My kids loved it. Everyone had a great time.
Yeah, that sounds much needed. It was this May.
Yeah, just like a few months ago.
Yeah, and COVID started back in 2020, so you're talking about 2 years. It
Oof.
sounds like it was very much needed.
Yes, yes, it was
Where did
long
where did you
awaited.
guys cruise to?
So we went to Jamaica, the Cayman Islands, and Mexico.
That sounds
So
like amazing. Nice
it was, it,
tropical weather.
oh, it was amazing. It was awesome.
Awesome, awesome. Well, I'm so glad to hear that, Veena. We are wrapping things up, and I just got a couple more questions for you before I let you
Yes.
skate on out of here. And this one is more of I'm not sure if you ever seen The Matrix with the red pill, blue pill that Neo
Yes.
had to take.
Yeah,
Okay, so
I'm old enough that The Matrix was out when I was like a kid.
it may not have been something that was interesting though to you. I know
Okay.
like not
No,
everybody likes that sci-fi type of stuff.
yeah, but like when it came out, it was like such a big deal. It didn't matter if you were into it or not. Like everybody watched
You're right about that. You're right about that. So
it.
what I want you to do, Veena, is I want you to be Morpheus, and I want you to give us a red pill, blue pill scenario that our millionaires are going to vote on taking once this episode releases.
Okay. Okay. I feel like I should have like had time to prepare for this question. Okay. And I'm going to see if I can make it multifamily oriented. So is it like it's an investment question?
It could be so I had one guest who hers was specifically geared towards the ladies. It was you choose to have a partner that provides for you financially but doesn't really treat you the best, and then on the blue pill, someone who treats you amazing, feeds your emotional needs, but cannot provide for you financially. That was an example of hers,
Oh,
and we,
that's a
we
good
weren't
one.
really talking about that. It was just,
No.
it could be whatever you want.
Okay. Okay. I'm gonna make it multifamily or investing related. Okay, I'll make it a question. This is actually, there's not really a right or wrong answer. It's more who you are as an investor. And if you don't know, your answer to this will actually help you determine it, right? So there's debt and equity that you can invest into one or the other, or both sometimes, but debt and equity. So in debt, you're investing not into the property, you own the right to lien and cloud title, you own the mortgage against the property. And it's usually a lower risk, but a lower return. So maybe you invest in debt and you get 6% or 7% annualized returns, or you invest into equity where you actually have ownership in the asset, but you take more risk because if the value drops, your equity could lose value. But in return for that amount of risk, you can get in multifamily today, you can get, let's say 15% return. So are you a debt investor where you want a 6 to 7% return steady with like no or very low risk? Or are you an equity investor where you want the high return and higher risk? And so 6% or 15% with the risk?
Mm, like that question. So we'll make the 6% the debt investment, the
Okay.
red pill, and then we'll make that equity investment the blue pill.
Okay. Which one are you
Awesome.
taking?
I think I'm going to take the blue pill, the equity
Yeah.
investment, just because I know with big risk come big returns. So
Mhm.
I don't really like the waiting game of steady, 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 and there's nothing I can do to increase or
Mhm.
get better. So I'm going to take the risk. That's just me
Okay.
personally. What about
Can you
you?
pick like half of each pill?
Ah,
Is that
no,
a
you can't take half of
question?
each pill. That would be very dangerous if we were
Oh,
medical
so I don't know what
professionals.
happens.
Yeah, I wouldn't advise anyone to mix pills.
Yeah, not medical advice.
All right, Veena. So let's say while you were on your cruise in May, you actually stumbled across a spitting image of 18-year-old you. What would be some
Oh.
advice you would give 18-year-old Veena?
Oh gosh. I like to live dangerously. So I like to say, like, go big or go bigger. Um, 18-year-old Veena was actually still in college. I was 2 years away from graduating. And I would say I wish I had started in business. I wish I had started a business when I was in college, and it was a lot harder than it is today. Now there's just way more tools and way more access to information and products. And I wish I would have started a business back then, even if it was going to just generate a little bit of passive income. I think it would have been nice to have had that business footing. And, there was no excuse for me not to, except I was obviously too lazy to do it, but I wish I would have put in the time and effort. Somebody once told me, front end load your sacrifice, and it's stayed with me for so long. It's something I use every day, even now. And so I think, I would tell 18-year-old me that, and I would have started a business then.
Awesome. I love that advice. I love that advice. Well, Veena, I know that you have a busy schedule. I want to respect your time. And before I let you get out of here, I just want to give you an opportunity to plug yourself in and tell our millionaires a little bit more where they can find you, any
Mhm.
projects you have coming up. I just want you to, be able to share that.
Oh, thank you. Yeah, I'm Veena Jetti. You can find me on social media. It's just Veena Jetti, super creative, I know. Um, I will say too that Instagram, like, I've been getting a lot of these fake accounts recently. So I will never ask you to send me cryptocurrency or anything like that if you connect with me on social media. All of our investments and everything are done through our website, www.vivefunds.com. It is a secure portal. And if you ever have questions, and this is just good advice just in general, but if someone's asking you to send them money like that, make sure you verify it with a person. Don't just blindly send them money, because we don't do that. Like, that's not how we operate our business.
Yeah, it costs to be the boss. And once you start doing, amazing things on social media, the fake accounts start to come.
Ugh.
So
No one ever did that to me before. And then all of a sudden it's like every day, like 2, 3 a day. And I can't get rid of them fast enough.
yeah, and that's unfortunately just where we are right now with social media and the direction it's going. It's just nothing we could do about it.
Frustrating. Yeah,
Yeah,
it's frustrating.
frustrating.
So
But that's great advice, Veena. It was amazing to have you on the show. I know our millionaires are going to get a lot of gems, a lot of game, a lot of insight about what you do, about real estate, the direction we're going in. So again, I just want to say thank you for your time, spending your, Thursday afternoon with me and with our millionaires. So I hope you enjoy the rest of your night. And to our millionaires, I want to say thank you as well for joining us week in, week out. You all are the reason we're able to get guests like Veena on the show and have me, have a better understanding on what you're looking for in the conversations you want to have. So with that being the case, I'm your guy, Kai Speaks. You just heard from Veena Jetti on multifamily real estate, collaboration, and funding. Just remember to keep focus, build momentum, and drive results so you can live abundantly. Peace.